Well, hi Russell, it's great to see you back at Durham University Business School. Now, I want to chat to you this afternoon in your role as the chair of the trustees of the HSBC Pension Fund, because you've been involved in some of the efforts to try and get climate change more recognised by companies and investors and the risks around climate change. So an easy question to start with: when did HSBC start to think about climate change as a risk issue?
Thanks, Carol, and as ever it's a great pleasure to be back here in Durham and to spend some time with you and the faculty. So I think the HSBC journey in the pension fund probably started over 5 years ago. I think we were quite well placed because our sponsor, the bank, has had quite a long-standing awareness of the importance of climate change in terms of its own business. And we started discussions around the trustee table really with a sort of an educational session where we had an external consultant who was regarded as being particularly knowledgeable, came and gave a presentation to us. One of the trustees at that time was actually the environmental advisor to the group. So we had a couple of people in the room who knew what they were talking about, and that was really our first step, thinking about what the long-term impacts might be. And it was then from that point that the journey started for us.
From your conversations that I'm sure you have with your colleague trustee chairs, are there other trustee boards that have these skills on the board that you're aware of? Is it common? I
don't think it's common, but I think most trustee boards have a reasonably good awareness nowadays. I think it's quite rare to find a board for one of the larger schemes that doesn't understand that climate risk is present in their portfolio. I think pretty much all those boards are also tend to have quite good strength in terms of their understanding of investments, and of course climate risk has a major impact on investment. So I think they have the sort of the knowledge of the markets and the investment process to understand it. They may not have individuals on the board that are particularly climate risk knowledgeable, but that's probably true of the corporate world, Carol, outside of pension funds as well, to be honest.
Yes, I think it probably is and should change. Now, last year, a 23-year-old in Australia took his pension fund to court over climate change. He thought they weren't doing enough to protect his future pension. And the Financial Times reported that lawyers of UK pension funds had advised their clients that the same could happen to them. Should they be worried, do you think?
Well, I think in the UK, the responsibilities of a trustee are clear. They're fiduciary responsibilities, and they can only really take into account matters which are of financial in nature. So if you happen to have a particular conviction about a theme, but unless it's in your trust deed, unless there's a financial impact, you're not legally permitted to take that into consideration. Now, when it comes to climate risk, I think it's clear the work of the Climate Related Disclosure Task Force, and indeed I think the general understanding in the system is that climate risk is absolutely a financial risk, and therefore it seems to me that pretty much most pension fund boards ought to be at least thinking about whether climate risk is a significant risk in their portfolios, and if so, what they should do about it. And I think there's really quite a big difference between thinking through the risk implications if you have a closed defined benefit scheme and if you have an open DC scheme. I think the example you talked about, Carol, is a defined contribution scheme where no doubt that young man is potentially going to be investing for, 40 or 50 years, and over those timeframes, climate risk might be quite a significant driver of financial returns.
So do you think then that defined contribution schemes are ultimately going to be better in terms of, better for the climate, and in terms of switching funds to less risky climate investments?
So I think the case for whether climate risk is significant for certainly for young DC members, to my mind, is really quite clear-cut. And think the question is then, what do you do about it?
Yeah.
I think with DB schemes, I think if you're closed and mature, I know this is true of my own scheme, we're de-risking, so we're gradually moving out of equities and into bonds and fixed income and infrastructure and real estate assets. So we have a different series of investment propositions and challenges to think about. But in the DC space, typically most default funds in UK DC schemes will have a very high percentage of equities because you want to take risk when your members are young, so you get the benefit of compounding. And of course the equity markets have got quite significant carbon and climate risk embedded in them. So then the question is, well, what do you do about it? Do you conclude that you're happy with the level of risk in your portfolio, or do you have a conversation around, well, what could I do to mitigate it, or perhaps to adjust my portfolio to improve the risk-return characteristics?
And so what are the main strands of the HSBC pension fund approach? I did read your letter to the Environmental Audit Committee and you talked about carbon tilting. Can you tell us something about that?
Sounds quite interesting, carbon tilting, doesn't it? And in fact, we've just made our first TCFD disclosures. They're public disclosures made by the pension fund, which we made a couple of months ago. So I think our philosophy has two or three strands. So we ground everything, and this is normal for trustees, in the beliefs of the board. So we typically will go through quite a rigorous process of discussion about what we believe in terms of our investment philosophy. And climate risk was one of the elements which we discussed, and the trustees believe that climate risk is a factor which needs to be addressed. They believe it is a factor which is financial and therefore is a risk which needs to be considered. That said, we have two main planks. There is the financial side and then there is the engagement side, and I'll talk about the two together. So on the financial side, our Chief Investment Officer put his mind to work on this problem over a couple of years and designed a quite innovative product. So he worked with Legal & General and FTSE Russell to develop the product which is now known as the Future World Fund. And it's a product which starts off as being a global passive equity fund, so investing in the time market. And there is the application of a so-called blend of 4 smart beta factors, things like adjusting your holdings of individual companies according to their, whether or not their disclosures are good quality, etc. And then finally comes the climate risk tilt. So that piece then seeks to reduce our level of risk to companies and sectors which are vulnerable to climate change. So particularly we do not hold any pure coal producers, and there's a significant down weight applied to oil and gas sector, as well as positively increasing holdings of companies which have a above average holding of or interest in green revenues and renewables. So a lot of work was done in terms of the portfolio design to get all of that to work in an efficient way, backtesting that to see whether or not it actually delivered improved risk return characteristics within an acceptable level of tolerance. And that's what we managed to achieve, gosh, over a year ago now.
In terms of getting a reduction in CO2 emissions long term, what does this tilting do? What benefits does it have compared to completely divesting in fossil fuel investments? So
this is a particularly thorny discussion, I think, around the typical trustee boards, actually, Carol, and there's pretty strong views in both camps. So I think my own board is in the engage, not divest category. Now, why do we believe that's appropriate? So
taking a step back, if I
yes,
may,
please.
If you're investing in them,
yes.
you can engage with them.
Exactly. That's the philosophy. And if you sell the stock, you're probably selling it to an investor that really doesn't care about climate change and won't engage. So the second plank of our climate risk management policy is engagement. Now we carry that out through Legal & General. They have something called their Climate Impact Pledge, and under that they wrote to the chair of boards of 84 leading global companies in 6 sectors. And they said to those companies, we're going to assess you for your resilience and the extent to which you've really thought about climate change. And they attempted to have a dialogue with those 84 companies. Attempted because in many cases it was a successful dialogue. In a small number it was a very unsuccessful dialogue. But at the end of that process they made the results public. So they commented on the companies they regard as being leaders and explained this is what we think as being good disclosure practice, good thinking about climate risk. And actually they then announced that they had divested from a small number of companies within the Future World Fund, and they would have voted against the reappointment of the board chair across their entire holding of equities in that company. And Legal & General was a very big investor, so that would have sent a message to those companies, we are serious about this, you need to change. I've heard at least 2 of the companies that they divested from because of lack of engagement actually then came back to Legal & General and sought to actually have a dialogue where there was none. But one of the companies was divested. It was an oil and gas company. In its sustainability report, in 150 odd pages, it did not mention climate change once. So, wow. Lack of credibility there, I think, Carol.
Definitely.
And I think your question around, I think you're right. Divestment, other than sending a message which we don't like what you're doing, I think most of the active investors I talk to in this space who are really serious about trying to change the trajectory of where the market is going, believe this engagement, particularly coming together of like-minded investors, engaging the companies in a meaningful dialogue around publishing perhaps scenario information, but also changing the business strategy and trajectory. They believe that is a far more effective route to follow.
Are there any examples where this engagement has resulted in real change that you're aware of, or is it too early?
I think I can think of a couple of the very large UK-based oil and gas companies where this approach of dialogue and seeking to explain and to gently encourage management to move has been actually quite successful. Yeah, I mean there tends to be little battlegrounds that flare. So we're heading towards the AGM season, and there's been a very effective campaign looking at a small number of these very high emitting companies and putting resolutions down, asking for disclosure, and then putting that to a formal shareholder vote. Not all of those have attracted the level of support that we would want in the first instance, but I think there is quite a strong trend to show this is a really very promising route to follow, and that really you just need to move 1 or 2 and then the whole sector starts to understand that this is a good thing to do. And I think the enlightened companies understand there could be competitive advantage here, is that if you're thinking about your exposure to a particular sector, you're going to be wanting to think about whether or not you go overweight or underweight. And then within that, where do you target your investment money? I think there's a good case to be made to say you'll target your investment money where there is transparency, particularly if there's investment needed to change the business model to move it from a high carbon model to a low carbon model. A company that is going on the front foot, explaining its plans, I think is more likely to attract support from investors as opposed to a company that's making no disclosure, stubbornly really not engaging with its investors about why its business model will continue to be successful.
So you're very keen then to see companies follow the recommendations of the Task Force on Climate-Related Financial Disclosure, which you've been very much involved in then. Yeah, good. Now, I did read some of the responses to a letter that the chair of the Environmental and Audit Committee wrote to the trustee chairs of, I think it was the 25 top pension funds in the UK, Mary Cree. And I thought there was quite a range in the responses in terms of both enlightenment and action around dealing with climate change risk. One that I particularly noticed was by Sir Ian Prosser, the chair of the BP Pension Fund, who described climate change as a potential long-term risk. And he said that his board of trustees hadn't taken specific action, but that they continue to monitor. What do you think of that response?
I think, to be fair, when you look across the 25 schemes, as with most relatively new areas of attention for risk management, and this probably is one of those, Carol, I think you expect to see a range of pace of movement. So we talked about the HSBC scheme. We're probably in the top 1 or 2 who've actually thought about it, come up with a policy and moved to actually adjust our risk profile. In my conversations with other trustee chairs, of which, as you can imagine, there are informal gatherings that talk about these things, I think there's a strong sense that pretty much most boards now understand that this risk is present. I think there is a growing understanding of the need to differentiate between their DB assets and their DC assets. I think what we still have yet to see then is a growing number of schemes moving to actually change their risk profile. I think that there are reasons for that. I did a presentation to a group of trustees a few months ago, and one of the comments played back to me, it wasn't BP, by the way, was a sense that a couple of trustees in the room thought it was riskier to do something about the climate risk in the portfolio than not to do something, which I found quite a curious comment. But there's a sense of if only a small number of your peers have actually taken action, there's a sense it's almost safer to not take action. Otherwise, you might be criticised. Was the hypothesis being put forward? Now, as you could probably gather, I don't find that particularly convincing. But I would hope that as we see a growing number of pension funds actually making positive steps to adjust their risk profiles, it provides case studies which I think gives confidence to others. And as you know, I sit on another board. I sit on the board of Willis Towers Watson's Master Trust LifeSite. And last year, the design of their core equity fund was changed to actually build in ESG factors. And again, that was not just engagement, it was actually changing the risk profile and adopting ESG. And obviously, climate risk is part of ESG. So it's another example where a major institution has actually moved to change what's happening within the investment funds. So I'm mildly hopeful. Of course, I'm always, as you know, quite impatient. So I'd like to see more action and it happening more quickly. But we'll see where we get to.
Russell, thank you very much.
My pleasure, Carol. Thank you.